Every financial crisis looks like an accident. History shows it's usually the final step of a long decision chain. Welcome to Wheelixon, where history isn't just remembered, it's used to understand how money, power, and systems quietly break. When a financial system finally cracks, the public reaction is almost always the same: shock, confusion, and disbelief. People say, "How did this happen so fast?" And no one warned us. This came out of nowhere. Applied financial history tells a far less comforting story. Financial crises don't arrive suddenly. They arrive quietly, after years of preparation. Not preparation in secret rooms or conspiracies, but preparation through repeated, rational decisions that delay correction in favor of stability. Every system eventually reaches a moment where reality becomes uncomfortable. Debt grows faster than income. Assets disconnect from fundamentals. Institutions survive only because rules bend. At that moment, leaders face a choice: correct the problem now, or delay the correction to preserve calm. History shows which option is almost always chosen. Correction is honest. It forces losses to be recognized, bad investments to fail, promises to be reduced. Correction is visible. Invisible pain threatens authority. Delay, on the other hand, feels controlled. It spreads pain slowly. It hides consequences inside technical language. It preserves confidence, at least on the surface. So systems delay. This behavior didn't begin with modern central banks or financial media. It began the moment power learned that truth has consequences. In early monetary systems, truth was unavoidable. Money was metal. Gold weighed what it weighed. Silver contained what it contained. If a state overspent, it ran out of money. Discipline was automatic, but discipline limits ambition. As empires grew larger, wars more expensive, and promises more complex, honesty became dangerous, because honesty forced immediate limits. The Roman Empire solved this problem without admitting failure. When Rome could no longer fund its obligations, it didn't reform spending. It debased its currency. Coins still circulated. Wages were still paid. Taxes still flowed. On paper, stability remained. In reality, purchasing power declined. The system didn't collapse. It adapted by delaying consequences. Rome survived for centuries after the first debasement, but the discipline that once held it together slowly disappeared. This pattern repeats everywhere. In medieval Europe, rulers faced constant fiscal pressure. Default meant rebellion. Rebellion meant execution. So monarchs borrowed, diluted currency, and postponed repayment. Reform required saying no. Delay preserved power. Modern financial systems refined this approach even further. They removed metal entirely. Paper replaced gold. Digital entries replaced paper. Delay became easier. Today, reform still exists, but it carries political, social, and economic cost. Reform means allowing institutions to fail. It means unemployment spikes. It means market crashes. So systems avoid reform until they have no choice. Instead, they deploy delay mechanisms: inflation, debt rollovers, liquidity injections, regulatory flexibility. Each tool postpones adjustment. None of them fix imbalance. Inflation is one of the most effective delay tools in history. It reduces debt without default. It lowers real wages without announcement. It transfers wealth quietly. Reform would require renegotiation. Inflation dissolves obligations silently. Debt restructuring follows the same logic. Rather than admitting insolvency, systems extend timelines. Deadlines move forward. Targets soften. Definitions change. The problem remains, but it feels manageable. This is where crises begin to form, not during collapse, but during management. Applied financial history shows that when systems shift from solving problems to managing perception, instability is already present. The management phase has clear signals. Emergency tools become normal. Temporary measures lose end dates. Rules bend just this once, repeatedly. Markets look calm. This calm is not health, it is signal suppression. History shows that the period before collapse often feels strangely stable. Volatility drops. Confidence appears strong. Growth resumes, unevenly. This false calm convinces people the danger has passed. In reality, correction has only been delayed. Japan offers a clear modern example. After its asset bubble burst in the early 1990s, Japan faced widespread insolvency. Banks were effectively bankrupt. Assets were mispriced. Debt exploded. Reform was possible. But reform would have been brutal. So Japan delayed. Banks were supported quietly. Losses were absorbed slowly. Debt expanded year after year. The system survived. Growth did not. The crisis never exploded. It stretched across decades. Europe followed a similar path during sovereign debt stress. Deadlines extended. Targets adjusted. Rescue mechanisms multiplied. Each decision felt reasonable. Together, they ensured the crisis never ended. It simply aged. This is why financial crises feel sudden to the public, because the preparation phase happens out of sight. in policy language, in accounting adjustments, in regulatory reinterpretation. By the time reality becomes visible, the system has already exhausted its ability to delay. When delay finally fails, events accelerate. Currencies reprice. Markets move violently. Confidence breaks. And people say, how did this happen overnight? It didn't. It happened slowly, until it couldn't anymore. Applied financial history teaches that collapse is rarely caused by one mistake. It's caused by a long refusal to correct early. Each delay increases dependency on stability tools. Each interventio in reduces future flexibility. Eventually, the system becomes fragile to even small shocks. This fragility shows up first in behavior, not headlines. Capital quietly exits. Real assets are hoarded. Parallel markets emerge. Talent migrates. These are not crashes. They are pressure leaks. History shows that when official narratives suppress truth, unofficial behavior reveals it. Crises become inevitable not because solutions don't exist, but because systems choose comfort over correction for too long. Reform hurts immediately, delay hurts eventually. Every system chooses its pain. Understanding this pattern changes how you see the world. You stop waiting for crashes. You stop reacting to headlines. You start watching behavior. Are rules bending more often? Are emergencies becoming permanent? Are timelines quietly disappearing? Those signals matter more than forecasts. Delay can buy time, but delay without reform doesn't create stability. It creates fragility, and fragility always breaks under pressure. History doesn't repeat loudly, it repeats quietly. By the time everyone notices, the preparation phase is already over. That's why financial crises never feel fair. The cost doesn't fall on those who delayed reform. It falls on those who trusted stability. Applied financial history isn't pessimism, it's pattern recognition. It shows that systems don't collapse suddenly. They collapse after exhausting every option except honesty. If you want to understand money and power beyond headlines and panic, subscribe to Wheelixen.